That's a pretty good indicator of impending trouble when people's confidence in the following year is so lousy. And it's unusual. And it has seldom been this bad. History will say that the 21st century is unusual, abnormal, aberrant even. The window from 2000 until now has been abnormally high profit margins, abnormally high PEs, abnormally low interest rates, etc. 40 years of lower and lower interest rates push asset prices up, particularly housing, through the mortgage mechanism. How can it not? If you can afford to pay more for your house because the mortgage rates are 3%, sooner or later you pay more for it. And so the competition bids the price up to fill the available affordability. Now the mortgages are 7%. The same will happen in reverse. Doesn't happen overnight. Everyone in the market wants everything to happen yesterday. But with interest rates and mortgages, it can take a long time to percolate through. But you can be absolutely certain that it will. If the world were to behave like it has behaved in every other major bubble, that's all it would take.
Are we in a major bubble?
Yeah, of course. If you look at a 10-year smoothed average PE and a Shiller PE, you find that there's a pretty decent spike in 1929, a much higher spike than that in 2000, and a slightly lower spike than that now. This is approximately the second highest point, higher than 29. And in each case, they back and fill and they go back to more average levels, even if you allow for a moderate increase in the normal Shiller. We know the market doesn't like inflation. Let's find other things that the market likes or doesn't like. And let's explain on a coincident basis why the market sells high and low. It turns out the market is a coincident indicator of comfort. What makes the typical portfolio manager feel comfortable? And number one, it loves low inflation. It hates high inflation. It likes 2% stable inflation. It does not like to see it bouncing around. It doesn't like to see it spike in the worst way. And it does not like to see it hanging around for multiple years. That's the most important one. Secondly, it loves high profit margins. What a surprise. Now, way down in third place is the stability of growth. The growth rate does not have a positive correlation with PE. The market is nervous about bursts of high growth. It doesn't like +9, -2. It would rather have +3, +3, +3 than +9, -2, even though it averages higher. It likes certainty, stability. Yeah. Comfort is the best description. So you look at this model and it says 1929 should not have been a surprise. It had low inflation, high profit margins, wonderful profit margins, incidentally. And the growth rate was ticking along at a pretty high rate and it was stable. So heaven. The market called the Great Depression. Everything was bad. It got the Nifty 50 right on the nose. It got the idea in the 70s that you'd be 7 times earnings because terrible inflation, persistent terrible inflation, low margins, wild economic growth. So at 6.8 times earnings was the trough. And the model called for almost exactly that. So then it makes what you might call a major error for the first time in 2000. It says in 2000, wonderful profit margins, no inflation, you'll have the highest PE that you have ever seen. Not bad directionally. Instead of 21 times in 1929, a new peak of 25 times. And it goes to 35 times. And that was not explained by anything we could see in history or then. It just happened. You could argue that that is the only really crazy psychological event up until then in American history. We got it 18 months later, it's back on trend. We got the setback, we got the housing bubble right, we got the wipeout right, and then it brings us to the second major deviation. Second major deviation starts in the second half of 21. Second half of 21, we have an inflation spike. Every time we've had an inflation spike in history, PEs have gone down, sometimes rapidly. This one was a strong inflation spike, bloody PEs went up, creating a major gap where the model goes down and the market goes up. And suddenly we've got a big gap. Then the market says, after all, I'm not sure I believe the Fed. And the beginning of 22 is the worst 6 months since 1939. But the model is still going down because inflation is hanging around and the model declines. So fast forward, what does it say today? It doesn't like the pattern of stickiness in the inflation. It doesn't like the profit margins, which in real terms have been coming down quite steadily now for over a year. They're down over 15% adjusted for inflation. And the model calls for 16.8, which in the long term is still pretty high. But the actual market is 29.
Times earnings.
Yes, on a Shiller, smooth basis. And on a Shiller, it's 29. This is a pretty handsome gap. And what this says is that is if the market responds to the same forces that it responded to over an entire 100-year period. It's only been different for a couple of years since inflation spiked. Do we really feel the market is cool about inflation, that it will not get a moment of second thoughts like it had at the beginning of 2022? Maybe this is not going to be as neat. Just back up a few weeks and we reached this kind of honeymoon period once again where everyone was confident we were going to have soft landing. Now, 1929, 2000, 1974, the Nifty 50, every one of these we were going to have a soft landing. Trust me, check the data. Everything was going to work out fine. It never does. If you want to look at the great bubbles and nothing but the great bubbles, what you find is the most interesting distinction is one that is unique to them and nothing else. It never happens any other time. And that is the leadership of the market going up, 70, 80% in a year starts to go down as the blue chips continue up. Now, the ones going down have a beta of 1.5. They're meant to go up 50% more than the market. They can't even get the sign right. So in 1929, the S&P was kind enough to have a low-priced index, which was pure junk. Pure junk had been up 80% plus in 1928, and it's dropping all the way through 1929. The day before the crash, it's down almost 40% before the crash. It is the great, I like to say, primal scream from the stock market, ever, up until then. Nothing like that happens again until 1972. In 1972, the S&P is up 17. The average big board stock is down 17. That's not bad. Then nothing like that happens again until 2000. In 2000, we know what happened. They take out the growth stocks and they go down basically 50% before rallying. And the rest of the S&P goes up.
Yeah.
So in September, the S&P is the same as it was at the peak in March of 2000. Right. In the meantime, the growth stocks have gone down 50%.
NASDAQ has gone down huge.
So the rest of the S&P, ex the super growth stocks, has gone up about, we calculate, 13, 14, 15%. Same thing has happened. High beta stocks have gone down, blue chips continue up. And it happened this time too, only the fourth time in history where going back to 2021, starting with QuantumScape and quickly going through Cathie Wood's portfolio and on through the meme stocks and everything. There is an ugly year following my waiting for the last dance. Lasted right through the end of December. But that is exactly what it did in the other three bubbles. In other words, if you're predicting a bubble, you should be saying, and the characteristic of this decline will be this unique, odd event where the super leaders with the highest betas go down as the last gasp of the blue chips. And then the bubble will break. I think the temptation to manipulate these major variables is overwhelming, particularly done in the interest of saying the market can go up a lot. I have a long history of dealing with this tendency over a few decades, and I get it. It's nice to be optimistic. And given half a chance, the investment business, of course, has a commercial imperative. It absolutely has to be bullish. It doesn't make any sense to be anything else. It maximizes their return over the full cycle, and that's how they do it every time they're bullish. So you never expect a major investment house to be bearish. They are risk factors. Price to book is the market's definition of who's got the most suspicious assets in the business. And small cap are more likely to go out of business, of course, than large cap. So when you buy them, you take on some risk and you expect a higher return. Quality, on the other hand, they have less debt. They are less vulnerable to a financial crisis. They are solid enterprises with long histories. They are less vulnerable to an economic problem. A AAA bond, everyone knows and expects it will yield 1 point less than, say, a B, right? That's the law of nature. You take less risk, they go bankrupt less. The AAA stock, however, has a long history of returning 0.5% more than the market. It's ridiculous. It's the only free good. It completely clashes with the early versions of the efficient market hypothesis. It says, by taking less risk of all kinds, less volatility, less any kind of risk, less beta, less bankruptcy risk, you still get an extra 0.5 point a year, whether it's 100 years. Last 10 years has been a little bit better than that. Last year has been considerably better than that. So it is very much a candidate for the only free lunch in the investment business. High, stable return with low debt. If you meet that category, it would be high quality and a good balance sheet. The FANGs have very high average quality because they are, let's face it, monopolies. And they have great pricing control, obviously, and they have good profit margins. They aren't necessarily higher quality than Coca-Cola, but combined with growth, they're pretty damn high quality. If you add that up, what it shows is that from 2010 until today, the US market in total goes up 70% better earnings than the rest of the developed world. It has never done that in history, and it probably will never do it again. But for 10 or 12 years, it had this amazing 70% excess performance. If you take out the FANGs, the rest of the American market did better, maybe by 10% or 15%. But that's the margin by which they've done it a few times in history. It was the Magnificent Seven, or whatever we want to call them, that turned that 15% outperformance into 70. I mean, Jesus, 70 is a big number for a 10 or 12-year outperformance of the rest of the world. These guys have some of the most magnificent leadership in the history of capitalism. Plus, they had an almost infinitely favorable environment, such as no monopolies. They're all monopolies that were allowed to monopolize. And they did it very, very well. These guys, your Magnificent Seven, they're all dealing with brand new ideas that had never been tried before. Nothing like Google, ever. Completely transforming, revolutionizing, really, the acquisition of data in a hurry. Actually, you'll find that the Procter & Gamble's and the Colgates of the world and Coca-Cola's, they have been aggressively, finding the smallest African country will have Coca-Cola and Colgate toothpaste if you look hard enough. And Apple, it was even pretty capital intensive. It's a kind of metal basher, isn't it? On which they had to superimpose style and luxury and functionality. They just had to be one step ahead of the competition in the combination of style and functionality. This is really desperately difficult and incredibly unusual. Maybe the world will turn against them, and the mean reversion will be a slow-burning, semi-political kind, where a few countries will say, it is not to our long-term advantage to have this degree of monopoly over this big a chunk of our economy. That would be a danger I would worry about if I were them. Basically, I say, I've been here, done that, terminal paralysis, we used to call it. Everything looks ugly. I know how you feel. You feel paralyzed. It's not that you are deciding to do anything. You can't make decisions. And what you have to do is overcome that. You have to get a battle plan together. Even a half-baked one is a lot better than nothing. These are cheap prices. You haven't seen anything this cheap for 22 years. That's a long time. It will more or less guarantee that you do pretty well for the next 7 years on our data. We had double-digit on the S&P for 7 years. This was a far cry from 2 years earlier. So put together a plan and start investing your money, however fast you invest it. You can't be too aggressive in those situations, because even if the market goes down another 25% in the next month, it doesn't matter. If you've been out of the market, you don't need the bottom. We're already a hero. How do you maintain your hero-ship? Is getting in with a lot. In real life, what happened is that I argued for this time is different. 5 most dangerous words. This time is never different. I debated the topic of we are in a bubble in 2016. I took the no, it's not a bubble. And the other side was, yes, it was a bubble. I was not looking. I was into this time is different. The surge that took place in late 2020 finally had the characteristics that had been missing this epic 10 years. The mania came out. As I have said many times, written many times, bubbles, it's not just about price. If you get price and it's boring, that is not a peak. Higher prices plus crazy behavior, which is unique, that you have never seen anything quite that.
And NFTs qualify?
Absolutely. Yes. Meme stocks qualify.
Sure, absolutely.
QuantumScape is the biggest scale of any bubble in history. There was nothing that scale. Any individual stock. Okay. Japan, real estate is the mother and father of all bubbles, much bigger than their stock market, which is the mother and father of all stock bubbles. Their real estate was over 10 times downtown Manhattan. And downtown Manhattan was very high priced. Downtown Tokyo was over 10 times. That's the biggest bubble, I think, in history, including the South Sea bubble. Stock market in Japan went to 65 times stated earnings. There was some cross-ownership complexity, but it looked like an amazing, amazing bubble. I think everybody else is guilty of the usual crime of expecting a soft landing when it never comes, but is always claimed, believing the Fed, who has never gotten one of these bubbles right, regardless of the fact they have involved several different Feds, underestimating the time that it takes for some of these things to work through, particularly real estate. And I'm sympathetic on that one, because real estate is a global bubble. It has driven house prices provably to multiples of family income all over the world. China, Beijing, Shanghai, you tell me, 15 times, 20 times family income, Sydney, Adelaide, etc. Canada, the UK, London. There used to be multiples of 3.5 times family income. London is now 10. Toronto's worse, etc., etc. No one can afford to buy a house now. No young kids coming out can buy a house. This is not a stable equilibrium. Furthermore, the mortgages have gone from 3, which explains everything, to 7, which explains nothing. And eventually, the 7 will start to explain quite a bit. But how long does it take? I mean, just think. The first reflex is, I can't move, for God's sake. I can't afford to go from 3 to 7. Sure. So I am going to stay, which means no houses are on the market, which means for the handful of people who have to move, they're actually in a bidding war. Real estate has never been about 3-month predictions. It works slowly but surely. In the end, you pay more because you could afford to. In the end, you will pay less because you can't afford to. House prices will come down in everywhere. 30 would be a pretty good guess. Now, let me get on to a quick subdivision that everyone has forgotten. In the 70s, 80s, 90s, we always stated everything inflation adjusted. Nobody is stating anything inflation adjusted now. Anything. Let me point out that in the great cycle from 2002 to the housing bubble, emerging outperformed by 180 percentage points. It went up 2.8 times the S&P. These cycles can be huge. And then it's been hammered like everybody else in the world. The way to look at this event is the aberration is non-US equities. Every asset worth talking about has been driven up by 40 years of declining rates, as you should expect, led by housing. But farms and forests, which we have some interest in, they've all gone from yielding 6% to yielding 3%. Fine arts, all gone through the roof. Everything has gone through the roof. The US market, through the roof. But non-US equities are curiously left behind. And I can't tell you why, because I'm not sure I have a reason for it. Every asset should be pushed up by low rates, and they all have been, except equities outside the US. In a nutshell, if you short these kind of stocks, you will have a short but exciting career. Because sooner or later, one or two of them will go up 6 times, and you are asked for 6 times the money you put up, and you are out of business. That will not happen to the Russell 2000. Okay. They also have the highest debt they've ever had in history. Almost no earnings. Most of the time, the Russell 2000 doesn't have earnings. When you push the PE, you'll get a not applicable. I believe you get it today. But the point is, if you add them all up, including the negatives, collectively, they have no earnings most of the time, I think, including today. So they have lousy earnings and the highest debt they've ever had. They are zombies. If we have bad economic times, they will get croaked. If we have a financial crisis, they will get croaked. You don't know how these guys will do. They will go down a lot in the stock market, but the first excuse, some of them will bounce. You cannot go short these kind of stocks. Do not go short, period, if you don't have to. If you have a portfolio like I have, then you have to go short. You pick the safest thing to go short. You never go short individual names, and if you do, you never, ever go short that kind of individual name. This time it's different. It's completely different. Always different. Let me first of all agree that, as I already have agreed, the FANGs are unusual, remarkable, and some of the candidates for best managed new enterprises, relatively new enterprises in history. Let me also add that every bull market, people always say, isn't it true that the composition of the S&P has changed? Yes, it always has. And if you regrade it this way, doesn't it make it cheap? Yes. Every single bull market of my career, that argument has been offered. It is a very tempting, seductive argument. In the end, it's all part of one pie. And do you think it's totally unlikely that you'll come back in 20 years and 2 or 3 of the Apple-type companies will have received, for unexpected reasons, some terrible shot in the gut, that some miserable countries, perhaps including the US, have moved against them in some way. Some technology shift has made 1 or 2 of them totally redundant almost overnight. A new way of getting data, a new way of shuffling this or that, a new iPhone technology at 1/4 the price. Who wouldn't like a wonderful flipping phone for $250? Go back to the Nifty 50. For 15 years, there were no casualties. The following 15 years, who would have guessed that Avon, Eastman, Kodak, Polaroid, and a couple of others were taken out and shot? The odds are a couple of these guys will be shot. It's shameful, by the way, that they are allowed to rampage. I think they should have some leeway, but to the extent that they're buying up everything, if they are, that would be a shameful state of affairs. Every category, rich, medium, poor, feel nervous and less well off than they were last year, regardless of the data. And some of the issues that came up were the ending of some of the stimulus programs, like no payment of student debt, just ending, one after another. That's a pretty good indicator of impending trouble when people's confidence in the following year is so lousy, and it's unusual. Secondly, do you know what the record of the leading indicators is? It's dynamite. The leading indicator is a wonderful indicator, and it has seldom been this bad. But the great bubbles, and they're the only ones I'm interested in, the 4 great bubbles, they can take a long time. The bear market in 2000 was a 3-year bear market, and that was a gentle recession. No problems. The housing market was cheap. The bond market was cheap. It was as specific and localized as you could get. And we had a 3-year bear market, 72% decline in NASDAQ. Amazon went down 92 or rallying like mad. This was pretty painful. You make a mistake, you have a Great Depression. You make a mistake, you have a recovery like the 70s. Since Greenspan, the Federal Reserve has got nothing important right? Every time it turns, it gets it wrong. Every opinion it gives about a soft landing is wrong. And their battle plan has been wrong. Their battle plan was push up the market to help the economy. And they pushed up the market, and they pushed it, and they pushed it 3 different times, and it did help the economy. The trouble is, they always went down. And that comes in with a negative economic effect exactly when you don't need it. And they keep very quiet. They actually brag about the upside help to the economy. So they have it rise through the 90s and collapse in the early 2000s. Then they have it rise to the housing bubble and collapse with the housing bubble. And the financial world is brought to the edge of destruction. It really was on its knees. And then they push it up, and here we are once again. Same high prices, about the same as 2000, and far higher than anything else. Higher than anything else. Higher than anything else.
When I was 11, I picked stocks. I had the whole wrong idea. I was interested in watching stocks, and I thought stocks were things that went up and down, and I charted them. I read books on technical analysis. I read Edwards and McGee. I think that was the classic then. Hundreds and hundreds of pages. And I read that whole thing over and over again. I read everything. And I thought the first 8 years, I thought the important thing was to predict what a stock would do and predict the stock market. And then I read Ben Graham, when I was 19 or 20. And I realized that I was doing it exactly the wrong way, but it didn't hurt that I had that background and everything. And I rejiggered my mind, and when I read the book, The Intelligent Investor, from that point, I never bought another stock. I bought businesses that happened to be publicly traded, but I became an owner of a business, and I did not care whether a stock went up or down the next day or the next week or the next month or the next year, and I didn't have any idea what it would do. I didn't know what the stock market would do, but I knew businesses. I'm a bright guy who's terribly interested in what he does. I've spent a lifetime doing it, and I've surrounded myself with people that bring out the best in me. And you don't need to be a genius in what I do. That's the good thing about it. If I went into physics and a whole lot of other subjects, I'd be an also-ran. But I am in a game that you probably need 120 points of IQ, But 170 doesn't do any better than 120. It may do worse, probably do worse, but you don't really need brains.
What do you need?
You need the right orientation. 90% of the people, I'm pulling a figure out of the air, but 90% of the people that buy stocks don't think of them the right way. They think about something that they hope goes up next week. And they think about the market as something they hope goes up. And if it's down, they feel worse. I feel better.
And you think about?
I think about what the company's going to be worth 10 or 20 years from now. And I hope it goes down when I buy it, because I'll buy more. I try to keep my competitive spirit in a game where I can win. I do know this. When I want to do something, I always want to do it big. I put my whole net worth in City Service Preferred, $114.75. Right. And I've never, since that day, in March 11th, 1942, I have never had less than 80% of my money in American business. You can call them stocks.
Or equities.
But I see them as American business. I've owned a piece of American business, at least 80% at all times. I don't want to own anything else. I want to own a home and things my family wants and all that. But owning 5 homes doesn't mean anything to me, because I'm going to be happy in one home, and there's a certain amount of things that go wrong with everything. And if I got 2 homes, I know I've got more problems and I don't have more happiness.
What brings you the happiness?
What makes me happiest is what I'm doing. I enjoy 2 things about it. One, I know I'll win over time. That doesn't mean I'll beat everybody else or anything like that. But I'm in a game that's very, very, very easy if you have the right lessons in your mind about what you're buying. I'm not buying stocks. I'm buying pieces of overwhelmingly American business. And I'm happy when I'm doing it. I'm happier when stocks are going down, because I can buy more of them with the same amount of money. I'd be happy if I was a farmer. I'd want farmland to go down so I could buy more acreage. It just makes sense. I'll tell you the second thing I really like. I like being trusted by people. I would rather do what I do with partners than do it sitting in a room myself, even though I might make more money that way. Let's pretend there is no stock market. Let's say I had to buy these privately, like you buy a farm privately, like you buy an apartment house privately. They're investments. So you're looking to say, what can I do with money I've saved to put it away so I feel good about getting it back later under any circumstances, but not necessarily on a given moment. But if I have a farm, it's going to take me a while. But people would be so much better if they actually didn't have a stock market in terms of buying businesses. The United States economy, and it's very easy to look at the statistics on it. I mean, more people a greater percentage of the American population is wealthy now or having more income now than they've ever had. And if you look at whether Bank of America will give you their average deposit, I mean, you just look at the wealth. That doesn't mean everybody's wealthy, but it does mean relative to any other period of time. I mean, people have more money now. They get mortgages at lower rates than they've ever gotten. So if they want to buy a house or something, right today, you live in an environment where the bottom 2% in terms of income in the United States, the bottom 5%, and for sure the top 1%, all live better than John D. Rockefeller was living when I was 6 years old. John D. Rockefeller was the richest man in the world. And today, you can get better medicine, better education, better entertainment, better transportation. You can do everything better than he could. It's astounding. That's in my lifetime. If he wanted to watch a football game, he still had to go there. And I can sit there with this big screen, and they keep showing me the replay, so that explaining to me what happened and everything. And maybe everybody doesn't have a screen as big as mine, but damn near everybody has a screen or an iPhone or a computer or access to one. And they have access. When I was born, the dentist didn't use Novocaine.
So there has been progress, obviously.
Oh,
And nowhere more than in the United States.
there's no country that's done what our country's done. If you go back 3 of my lifetimes, you're looking at less than 1% of the world's population, closer to half of 1%, are sitting in this land. They don't work harder than people in all the rest of the world. I mean, in terms of hours of unpleasant labor, everybody's got hours of unpleasant labor in those days practically. They don't come laden with gold and, they are half of 1%. And they work the same hours, they got the same IQs. They may be a little self-selected in terms of enterprise, in terms of going across oceans and things. And fast forward a couple of lifetimes, and they've got 20% plus of all the bounty in the world. I mean, that is something that has worked like nothing. Just imagine that. If you've gone to anybody, Constitutional Congress, in 1789, if you go to any one of the representatives there, and you said, I want to tell you what this place is going to look like, in 3 more of your lifetimes, your great-great-grandchildren are going to be flying in the skies, they're going to be watching sports all over the world, they're going to be entertained, their medicine, they're going to hold you off to a lunatic society. Of what he's doing, he's getting 50 cars and he's getting a whole bunch of little claim checks. Just think of it. Everything, when Thomas Edison did all the things he did, he made some money, but we're using it. It belongs to us. If you take what an hour of labor delivered to you 100 years ago, and what an hour of labor delivers to you now for you and your family, it's unbelievable. Capitalism doesn't say get rid of a referee and a government. We've got a government that can tell capitalism what to do. And they do, and that's just what they should do. And they do it in different ways at different times and all kinds of things. But it's claim checks on future output. That was, and the claim checks belong to me, so if I want to buy 50 super yachts, I can do it. But what does it mean to me? It can buy more things for other people that are useful to them. It's not evil. The federal government is the boss in the end, and they shouldn't screw up capitalism, and capitalism shouldn't screw up the federal government. It's very simple. It's evolving, always. We started in 1789. We had business, and it's gotten far, 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 unbelievably more productive for people. And the only thing it can do with what it produces is give it to other people. It isn't like the 50 richest guys in the country can say, I'm just going to eat everything. They're turning out products. iPhone that I have, which I'm probably the least capable guy in the world of working with it, but it makes life better. But that comes with government. So far, we've got the best system. We've got a better system than we used to have, and we'll have a better system 50 years from now.
Why are you so sure?
Well, I've seen 91 years of it. I've never seen a period where I didn't believe that. Not every aspect. We can go backwards in some. No, it's not. But it's unbelievable what has happened. I mean, just think of it. We've had a civil war. We've had a Great Depression. We've had all these things.
Pandemics?
Yeah, I'll guarantee you we'll have something, next year and the year after and the year after. But in a herky-jerky but dramatic matter, business moves forward, government moves forward, more important, people move forward. I mean, I am happy to tell people that the same thing I've told them before, but it's They'll never get the message, most of them, but a few do, that the most, best thing to do if you want to invest for the long term
His index.
and it's the S&P 500 index.
Right.
And what's happened, of course, is that organizations like to grow. So they set up indexes on different industries, different countries. And as soon as you do that, you're violating basically what Jack Bogle said. He says you don't know enough to pick the right businesses, which means you don't know enough to pick the right countries, you know enough, right?
What do you think's coming for stock markets in 2024?
Not a pretty picture, but I think investors really should be prepared for the worst. If you're not getting out of stocks, if you want to be in stocks, I would recommend defense, energy, and mining. But I'd be out of tech, I'd be out of consumers, and I'd increase my cash allocation. I think I can keep this brief in the sense that a lot of what's going to affect the stock market is the geopolitical situation. So we talked about that in depth. But if you got a 401k and you're just buying the S&P 500 index from Vanguard or Fidelity, and it's been going up and it has been going up, there's no question about that. And you're like, I'll just sit there and watch it go up. Be careful. We've been warning about a stock market decline for a long time. It's happening. Wall Street's out to sell your stocks and CNBC says, up, up, up. There's nothing I see that's going to make that better. I don't think the Fed's done raising interest rates. I remember the 1970s, the stock market peaked, Dow Jones peaked in 1969. It didn't get back to that peak until 1982. Now, 1982 was the beginning of one of the greatest bull markets in history, grant that, but 69 to 82 is 13 years. It went sideways. Now, again, there's volatility and dips and peaks, and I'm not saying you can't make money, but I'm saying that there's a 13-year period when the stock market ended up where it started, number one, around 1,000 on the Dow. When you adjust for inflation, because we had massive inflation in the late 1970s, it was still down. That's 13 years. That's going to get worse because the U.S. is heading into recession, and we may be in a recession. Everyone's like, wait a second. Yesterday, GDP was up 5%, and it was up 5%, but it was very heavy on consumption and very heavy on inventories. Well, consumption, obviously, people don't realize when wholesalers and distributors build up inventory, that counts as GDP. Well, it's fine to build up inventory if people are buying the stuff, but if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you see, you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, this is what happens. They slash prices, they do 2-for-1 sales, they just move the merchandise, and particularly in certain areas, stuff goes out of style. The fashion industry is notorious. Who wants last year's coat or whatever. So then the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumers just hit the brakes. A couple of reasons for that. Number one is during the pandemic, you go back to 2020, 2021, what was going on? Well, starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you got a heartbeat, you got a check. And then Trump did it again in December, just before he left office, it was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February of 2021, right after he was sworn in. Here comes another $1,600 check. Then there was Build Back Better, the Inflation Reduction Act, which is actually the greenest scam. We were running deficits of $2 trillion a year for about 4 or 5 years. The total spending was higher than that, but that was the deficit alone was about $2 trillion a year. Well, the Americans got used to that. Thanks for the check. And then there was a deferment on student loans. You didn't have to pay your student loans for about at least 2 years, maybe a little bit longer. And then when people got those checks, they saved a lot of it. So what happened in 2023? People drew down their savings. The savings rate got really low, like 3%. It was up around 13% during the pandemic. It's a little over 3%, 3.5% right now, which is low. They spent the savings they had. They didn't make new savings. And then they turned to the credit cards and ran up their credit card balances. Well, that feels good for a while. But then if you're paying the minimum and rolling over the balance and you're at your limit, your credit limit's used up, and the interest rates are 20%, some of them are 28%, you're going to double that balance in 3 years. So if you're like, I'll just pay the minimum this month and I'll figure it out, your balance is going up because the interest is compounding faster than you're paying it down at 20, 25%. People are tapped out on the credit cards. They've used up their savings. They're getting into a deeper hole because the interest is compounding faster than they can pay off the credit cards. And it's showing up in things like gasoline consumption. It's way down. The demand for gasoline is what kind of is called inelastic, meaning you just have to buy it no matter what the price is. You got to take the kids to school or get to work or go shop, whatever it is. You're just going to buy the gasoline even if you don't like the price. By the way, lately prices have been coming down a little bit, which is another, that sounds good, but it's actually a bad sign because it's disinflationary, which kind of leans in the direction of a recession. But for gasoline consumption to drop, forgetting about the price, that means people are not driving. They're not going on vacation. They're not doing road trips. They're not driving any more than they have to. There are a lot of other signs. We don't have time to get into all the technicals with negative swap spreads and inverted yield curves and all the rest. But it does look like the consumer slammed on the brakes. The stock market's starting to wake up to that fact. So I would say it's a pretty simple recommendation, Matt. Reduce your exposure to stocks overall. increase your exposure to cash. You won't lose money on cash, assuming that inflation is not bad, and it'll give you a lot of optionality. You can go, if things get really, really, really bad, if you have cash, you can go shopping and find some bargains. But if you're in stocks and they go bad, you're just going to lose that money and never see it again. And if you do have stocks or some stocks, I wouldn't do the index funds. I would look at energy, defense, not for good reasons, there's enough wars going on, but defense will do well, and mining, because gold and silver prices and strategic minerals will do well. So defense, mining, and energy are the sectors I'd be in. I'd lighten up on tech, get out of everything else, go to cash. Treasury notes look attractive here because interest rates are going to start to come down. I know they've been going up, I get it, but it looks like they peaked and have turned around. So treasury notes, a good 2-year note, a 5-year note will perform very well, and they're very safe, obviously, and just take it from there. But you've got to be tuned into the geopolitics to understand the stock market. You can treat them as separate subjects, but if the world's falling apart, that's not good for stocks. I'm going to start with Ukraine. And the interesting thing about that is, of course, the war started, well, I would say it started in 2008 when George Bush declared that Ukraine should be a member of NATO. That was really the beginning of everything that's happened ever since. The U.S. was spent years kind of provoking this war. But the Russian special military operation started in February 2022. So we're about 2 years into this at this point. And I live in Portsmouth, New Hampshire. I'm here now, and we got our share of conservatives, but it's a pretty liberal town. And there's a section, an older section, where it's like all super liberals. And I remember in the spring of 2022, everybody had Ukraine flags out. They took down their Black Lives Matter banners and put up Ukraine flags everywhere. And I just looked at it. I had an open mind. I don't like to jump to conclusions. And I saw that Ukraine is the most corrupt country in Europe, one of the most corrupt countries in the world. It's an oligarchy. It was a money laundering machine for the Democratic Party. We sent the money and they sent it back, a lot of it in the form of campaign contributions. And a large percentage, maybe half the population, are Russian speaking, really consider themselves Russians. And I said, what's so great about Ukraine that the U.S. is supposed to go to the brink of World War III over it? But I kept an open mind. The more we went down that timeline, the more it was clear that Kiev, Ukraine, was just a corrupt skim operation. They'll take all the money we can give them, buy themselves houses in Dubai or Miami or Switzerland or wherever, and fight to the last Ukrainian. 400,000 dead. That's a conservative estimate. The actual number is probably higher. Just on the Ukrainian side, 400,000 dead for what? But everything about the war was misguided. The plan, if there was a plan from the neoconservatives, the warmongers in Washington, the State Department, White House, the plan was, we'll give them the money and the weapons, let them do the fighting. The Russians will come in, we'll bleed the Russians, we'll put sanctions on their economy, crush the ruble, cut off their exports of oil, cut off their revenue, kick them out of the bank message traffic system, kick them out of SWIFT, freeze the assets of the Central Bank of Russia. And not only will the military be depleted, but the Russian state will have economic unrest, will be a popular uprising, they'll overthrow Putin, and we'll march into Moscow. That was actually the plan. As ridiculous as that sounds, that's what they were thinking. It was never about Ukraine. It was all about defeating Russia, getting rid of Putin, and kind of running up a NATO flag over Red Square. None of that has happened. Everything about it was wrong and misguided at the time. And I said so at the time. I teach a course in economic warfare at the U.S. Army War College. You said I was a former advisor to the Pentagon. I guess I still am. I do teach this course, and I talk to people in the military on a regular basis. But I said in April 2022 that the sanctions wouldn't work. They would backfire. It would not hurt Russia. It would hurt us more than it hurt them. It would hurt Europe more, etc. And the Russian army they do get off to a slow start, but they finished the job. Anyway, all those things have played out exactly as I said. So they may unleash a complete missile bombardment from southern Lebanon that could hit major Israeli cities, Haifa. I've been to all these areas. If they unleash this, then Israel will certainly fight back. So then you're going to have a two-front war. And this is where the U.S. might get involved, at least with air power. But here's the big question. Does anyone attack Iran? And there's good reason to think that we're at the point where the U.S. and Israel, and obviously the U.K. are in on this. So you know what? All the money, all the training, all the advanced weapons are coming from Iran. Why don't we just take Iran out once and for all? And by the way, they're getting very close to having nuclear weapons. This has been discussed for 15 years. But has the time come to, sink their fleet, destroy their nuclear reactors, destroy their enrichment plants to the extent you can find them, assassinate their scientists, and who knows what else? I'm not saying that's going to happen. Hopefully it doesn't, because it's getting close to World War III, but that could be what happens next through an escalation process. Gaza, Hezbollah, just take out Iran, be done with it. The problem is you can't just take out Iran. I kind of shrug. It's like, well, but then the Russians will come in. And what if the Russians are escorting supply ships to Gaza? Where are we now? I can stop there, but my only point is viewers and investors should not think of this as Israel attacks Hamas for revenge or counterattack or whatever. Yeah, that is going to happen. But this could escalate to something like World War III and nuclear weapons involved very quickly. So let's not forget about that. And China, they're watching the whole show. They're ramming Philippines fishing boats in the South China Sea. Why do we have a war in Ukraine, a war in Israel, and something close to war in the South China Sea, and other trouble spots around the world, Syria, Iraq, etc. All of a sudden, it's because 2 years of Biden and nobody's home and they're taking advantage of it. Everybody else in the world says, hey, here's my chance. When we say bond markets, Matt, we have to be careful which bond market. I'm talking about the U.S. Treasury bond market. Short-term treasuries, 4-month bills, 6-month bills, up to 1 year. From 0 to 1 year, they're called bills. From 2 years to 20 years, they're called notes. And the 30 years called a bond. So if you're an expert, you say bills, notes, and bonds, but they're all Treasury securities. So I just want to be specific. We're not talking about corporate bonds, just to be clear, because those may very poorly. If companies are going to underperform, we're going to go into a recession. You're going to see bankruptcies increase. Those corporate bonds are going to get hammered, but certainly junk bonds. So we're talking about U.S. Treasuries. The funny thing now is that the highest yields in the U.S. Treasury market are in like a 6-month bill. Like, wait a second, shouldn't I get more if I buy a 30-year bond, or shouldn't I get more if I buy a 10-year note? It's a longer maturity, more stuff can happen, inflation, credit downgrades to the United States, bank freezes, all those things can happen. I want a higher interest rate for my longer term security. That's usually the way the yield curve looks. It's kind of goes upward sloping. The longer the maturity, the higher the rate. That's not true today. The highest maturities are right around 6-month bills, 1-year bills, going out to 2-year notes. When you get to the 10-year note, you actually get a lower interest rate, lower what's called yield to maturity than you do on a 2-year note. So the interesting thing about 2 years is you get a high rate, but it's less volatile than a 10-year note. It's more liquid. 10-year notes are pretty liquid, but 2-year notes are very liquid. So you can actually have the best of both worlds. You can have a shorter maturity, which means less risk in some ways, and a higher interest rate. So it's, like I said, the best of both worlds. But the highest interest rate is actually from 6 months to 1 year. So those are very, very safe securities, and they're paying between 5.25% and 5.5%. Well, yeah, Jim, that sounds good. But if interest rates go up even more, the answer is you're going to lose money on your capital. The value of the note or bond will go down if interest rates go up. That's bond math 101. Rates go up, prices go down. The opposite is true. Rates go down, prices go up. So you can make it lose money, but that inverse relationship kind of throws a lot of people. But yeah, buying a 2-year note that yields about 5.1%, very liquid, very safe, good return, more than your bank will pay you, more than most stocks will pay you. Why wouldn't you do that? Well, the answer is, if you think the 2-year note is going to go to 6%, you might not like it, because you're going to, if you hold it for 2 years, you'll get your money back. But if you want to sell in the meantime, you're going to have a capital loss. So therefore, the next level of analysis is, well, what's going to happen to interest rates? Everybody wants to know that. In my view, they've peaked. They're going to come down. And if you like that action, you might prefer the 10-year note, because a longer maturity, so interest rates come down a certain amount, 25 basis points, 50 basis points or whatever. And I said bond prices go up, which they do. But how much do they go up? Well, the answer is, the longer the maturity, the more they go up. They're more volatile. And so when I say risky, I'm talking about market risk. I'm not talking about credit risk. You are going to get your money back. But from a market risk point of view, if you had to sell it a year from now, or 6 months from now, for that matter, if rates go up, you're going to lose a little money on the value of the note itself. But if rates come down, not only do you get the 5% interest rate, which is sweet, but you're going to have a capital gain on the note, because that's what happens when rates come down. So the big question is, have rates peaked? And I would say they have. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown, we're looking at all kinds of geopolitical risks, stocks are coming down, then interest rates are going to come down too. The old cliche, which is true, a week is a lifetime in politics. Well, that's true. I hate cliches, but that one happens to be true. A week is a lifetime. A lot changes. And the answer I gave is, well, we're doing this now because the election is happening now. There'll be election day in 2024, a lot of early voting these days. I guess it really starts in September, whatever. But the election is happening now because things are happening that are going to determine what happens by the fall of 2024 in particular. Meanwhile, the world's blowing up. By the way, those two things are not coincidental. Oh, war in Ukraine, war in Israel, something close to war in the South China Sea. Oh, gee, it's too bad we don't have a leader in the Oval Office. They're not unrelated. The world looked at, I call it the Chernenko moment. You have to be a Soviet Union expert, but in the early 80s, they had a president, a general secretary of the Communist Party, leader of the Soviet Union, named Chernenko, who was brain dead. Sorry, I'm overstating. Not brain dead. He'd fall asleep in meetings, couldn't talk. But then he died, and they got another guy, Yuri Andropov, and then he died. And then somebody was like grilling, and then they got Gorbachev, and somebody asked Ronald Reagan, said, why won't you negotiate with the Soviets? And he said, they keep dying on me, which was true. But we, obviously the intelligence community, knew that Chernenko was mentally incapable. And it doesn't get better. If you know anything about progressive cognitive decline and the kind of diseases, there are no cures. There are treatments, but there are no cures, and then you die. And the Democrats know it, and they know what's going on. Gavin Newsom met with Xi Jinping, who's the president of China, the head of China, most powerful Chinese leader since Mao Zedong. What does that tell you? It tells you that Beijing knows that Gavin Newsom is the most likely candidate for president of the United States in 2024 on the Democratic side, likely to be the next president. And there's a long history. Foreign leaders, if you're running for president, you're not the president, but you're running for president, you get meetings with foreign leaders. You'll go to Israel, obviously Canada, Japan, China, because they want to know you just in case you win. They don't want you win, you get sworn in. They don't want you to be a stranger. So that's not unusual. But the fact that Xi Jinping takes a meeting in Beijing with Gavin Newsom tells you that the Chinese are saying what I'm saying. I think it's entirely possible. It's not just a guess. I do think it's likely that Trump will be behind bars. Trump will be in a Fulton County, Georgia jail on election day. I still think he's going to be the nominee, and I think he's going to win. So you're going to have this spectacle of Trump with orange hair and an orange jumpsuit, a prison jumpsuit, behind bars in the Fulton County jail, elected the next president of the United States. There's no prohibition on that, by the way. This is not impeachment. There's no prohibition on a convicted felon being elected president of the United States. There just isn't. It's not in the Constitution. They may have to give him a supervised release so he can go to the Oval Office. Trump's going to be convicted of a crime. Now, he's got lots of grounds for appeal. Appellate courts may throw it out. It may get reversed. I understand all that, but he's indicted on 90 felony counts or more in 4 different jurisdictions. But it's important to know that the world economy is slowing down. Germany is in recession. Japan is very close to it. UK, very close to it. Canada, I'm hearing nothing but bad reports, housing market collapse, etc. China may not technically be in recession, but it's slowing rapidly. The thing with China, it's the second largest economy in the world. They've been growing at 10%, 10% for over 20 years. When you compound something at 10% for 20 years, you're going to increase it by a factor of 10 or so over that time period, but not now. They're almost certainly below 5. They're going to print 5 because they make up the numbers if they have to. But when you strip out wasted investment, investment that you could build a massive train station with 128 escalators and marble walls, but nobody goes there and the tickets are $10. You can't pay for that. It doesn't produce any wealth. It just creates jobs. The real estate sector is collapsing. That's been the biggest driver. People are not stepping out to buy houses. They're not taking the bait. Lower interest rates haven't helped. China's in a massive slowdown. Whether it's technically a recession almost doesn't matter, because when an economy that big slows that much, it drags the world down with it. So China's not going to save us. Europe's not going to save us. And this is new. I'm going to throw another wild card here. It's a bit of a stretch to think the U.S. is going to dodge this bullet. If China's going to slowing down, Germany's in recession, Japan's getting close to recession, Canada, UK, emerging markets, the whole world, plus what we're looking at in the Middle East, the idea that the United States is going to boom while the whole world is going down is just not true. Globalization may be yesterday's news, but it's not over. Supply chains are still global. And we're seeing a lot of problems in the U.S. The U.S. has been doing better than the rest of the world. The rest of the world's not doing well at all, and particularly China. And the U.S. is going to follow the world into this global recession.
A lot of these guys are fearing what is taking place. Jamie Dimon says this is the most dangerous times we've had in America in decades. Michael Burry shorted the S&P 500, $1.6 billion of his clients' money.
My intuition is that a recession is inevitable, but the market can remain crazy longer than you can remain solvent, whatever the quote is. Why hasn't it happened yet? Only the paranoid survive, but how do we turn paranoia into an action plan?
Yeah, so everything is right now about mapping out different possibilities. World War III takes place. What do you think are the chances of this taking place? Ray Dalio says 50%.
Yes,
okay.
He does.
So if World War III happens, what happens to the economy? Who's going to be the parties involved? Are we going to be involved purely through proxy, or is there going to be attack here? Then you write down the possibilities. Okay. If this happens, what are you going to do? If this happens, what are you going to do? Then next, what happens if unemployment all of a sudden goes to 7%? What happens if inflation goes down? What happens if Powell starts lowering rates back down to 5-4%? Holy, that's going to be crazy. But here's a couple things that we have to be thinking about. Credit card debt, highest it's ever been. You know what's the craziest thing about credit card debt being the highest it's ever been? The average interest rate on credit card is the highest it's ever been.
Jesus.
Forget about the debt. So people are worried about the debt. The average is 23% on credit card. You know what 23% means. That means the debt doubles about 2.5 years.
That's like loan shark.
That's loan shark. 3 years, your debt is doubling, right? But that's what we got right now on credit cards. So our debt is record breaking. Forgiveness for your school loan is gone. So now you have to start paying for it. That's $300-400 a month that people are expecting, I think October, November starting. Then go to the corporations you were talking about that are borrowing money. This year, their interest payment is going to end up being around $530 billion. Just interest.
Oh my God.
Next year, it's going to 730. Next year, it's going to 1.1 trillion. In the next 5 years, it's going between 1.3 to 1.5 trillion dollars just on the corporate debt. Next part, mortgages. We're not saying anything crazy with people with bad credit not making payments. We're still good. Car payments in subprime. They're seeing a spike in defaults where people are not making car payments. The first sign you're seeing on what's taking place. Let's go to the next one. That's the scariest one. U.S. has $33 trillion of debt, worst it's ever been, the highest it's ever been. What does that really mean? Nobody can really figure it out. Here's what it means. Every single time the rates go up 1 point, just 1 point for the U.S. government, our interest payments increase by $320 billion. So imagine we raise rates by 3 points. Just interest, it's $1 trillion more per year. If it's 6%, $2 trillion more per year. That's that. Then last thing that I'll just kind of get you to be thinking about. Anytime you want to know if the economy is back to normal, go to Vegas. If Vegas is humming, like, okay, we're good. And always, whenever you go to Vegas, talk to cab drivers and talk to the drivers who are doing Uber. Always ask, how's conventions doing? Are you noticing things canceling? No, this has been crazy for us the last 3 months. Everything's good. But if they start seeing a downturn, they're typically an indicator of what's to come. One of my friends, their construction company, does very well. We have these 3 clients that we have who are doing transportation. 2 of them, numbers are down 40, 50%. One of them is doing $1 billion a year. Their revenue is down 70%. Why would transportation be down 70%? Aren't Walmart, Amazon companies ordering stuff to ship it from here to there? Why would that be lowering? What do they know that we don't know? Again, these are people who have data to insider stuff that we can sit there and say, these are great indicators when you're studying these things on what's going on. Does this mean recession is going to come here? My bigger fear is a reverse market crash, which Venezuela just went through. All of a sudden, rates get lowered and Dow and S&P goes. And Dow goes from 33, 40, 45, 50, 55, 60, just goes boom.
Is that just the dollar losing its purchasing power?
Yes, exactly. That's what happens. The more we're printing, like the inventory increases the more we print money. The more you print dollars and it's more accessible, the less it's valued, the less it's worth. You sit there and you're like, okay, so does this mean guys are not going to make a lot of money? No. You're going to see the first trillionaire in the next 24 months because none of this is going to affect the guys at the top. None of it. Every time they print money, the guys at the top make more money. If there's anybody that should be against printing money, it's low and middle income families. If there's anybody that's for printing money, guess who it is? The guys at the top. Why? Because the poor in middle America can't keep money. They spend it. And when they spend it, what do they buy? A product owned by somebody in the S&P 500 or other people who have businesses. Money flows up. They can keep printing money all they want. So when low and middle income families are like, look at these guys, all they care about is themselves. Let that bill pass for $2.7 trillion. You simply look at them and you say, you have no clue how money works. Guess what? Let's print $10 trillion. Rich are okay with it. You ain't gonna get the rich complaining about printing $10 trillion or $5 trillion. BlackRock's gonna be like, all right, cool. $8 to $10 trillion of money in our ETFs, and we're buying up a bunch of different companies. We're buying up all these properties today. Right now, it's going to be nothing, but in the next few years, you have to go through us, and we dictate the market, and we're going to own it all. And what are you going to do about it? The idea of middle America not being able to make the money they need to make to be able to afford a house, send their kids to school, live in a nice place, enjoy some of their dreams, maybe not the biggest ones, but some of their dreams are going to become a reality. Middle America is getting smaller and smaller and smaller every single time we print money.
You have to have a mechanism by which you put this new money that you created out of thin air by fiat, literally just saying it now exists. You have to put it into the system. The way it's put into the system is by buying assets, because typically low and middle income people don't buy assets. They buy products, like you were saying. Then they aren't beneficiary of that unless there are stimulation checks. Now those they will get sent directly to them. So there are ways to put it in their pocket. But what you're effectively doing is socializing losses. So you are spreading the loss out across everybody. My dollar buys less, and so it takes more dollars to buy the same thing because nothing fundamentally happened. The business that I own a piece of did not become more productive, and therefore can actually generate more by adding more value to the world. Once you understand that, like I actually, as a wealthy person, do complain when people print money, because I'm like, hey, there is a point at which you break everything, because the money is just going to hyperinflate, and it isn't only going to be the stock market that goes up, it's going to be the cost of bread and gas and taking your family to a movie and all of that. When COVID happened, that actually kept us from going into something that probably should have been worse than the Great Depression. The money printed their way out of it, and we ended up being okay because it was spread across a lot of people. Now, because I am such a student of Ray Dalio, I know that governments, once they start money printing, they can't stop. And every time in human history that it's been used as a tool, it's used until it breaks. Until it breaks, every time, without exception. And typically, as it's racing towards breaking, I think it's 8 out of the last 14 times it's ended up in a hot war. As the big debt cycle comes to an end and money's inflating away to nothing, debt is completely out of control, nobody can make their payments, everybody's defaulting, you have to have a complete reset of the wealth, which is, I think, why everybody calls this the Great Reset or the Big Reset or whatever. Because we are forestalling catastrophe right now by printing, but we are only forestalling it. And nobody, I've had a lot of people on the show, nobody can tell me how you pull out of this death spiral other than austerity, and no one's going to do austerity.
Yeah, so how can you fix this thing? My question would be, how do you fix this thing in a year? No one's going to know how to fix it because it's not going to happen. How do you address this and make progress towards getting better over a 20-year span? Okay, now we're talking. 40-year span? Even better. The problem with America today is the following, which, by the way, is a beautiful thing, but it's also a problem. whoever that gets elected, we have cyclical cycles, okay? You got Carter gets elected, then it's Reagan Sr., then you have Clinton, then you have Bush, then you have Obama, then you have Trump, then you have Biden. So Republican, Democrat, Republican, Democrat, Republican, Democrat. So every time you do this, every 8 years, the system is like changing. So cycles are changing. Whatever you're doing is changing. So you can't really consistently build on a philosophy over a 20-year period, because in America, you can't put a 20-year plan in place. There is no such thing as a 20-year plan in America, because whoever's the next guy that's going to come take your job is going to say, no, we're not building that wall. No, we're not going to do that. No, we're going to cut those benefits. No, we're going to add these benefits. No, we are going to spend more money. No, we are going to leave this war. No, we are going to get into this war. These things, the complexity of what we're asking about is challenging, because no one leader is going to run for 20 years. We just don't have that.
Would you want it?
Is it good for America long term? Absolutely not. If that one person's a shitty person that gets into office for 20 years, this thing's gone. It's destroyed. At least this allows us to not be able to go super extreme, because you have to get it through Congress and Senate, and it's already complicated enough to do that. But to fix this thing, you're never going to have both sides agree philosophically, economically, on what they're going to be doing over a 20-year span. You have the war right now with China and India. iPhones are now being made in India. You can now get iPhones where on the back of it says made in India. First time. Not made in China. It says made in India. Really? Guess who blocked TikTok in their country? India. Guess who's blocked 100 apps of China? India. India is not afraid of China. Now, why does China not like India? Why do they always behind closed doors talk shit? Yet at the same time, they're part of BRICS. You got Brazil, you got Russia, you got India. You got China, and I think it's South Africa that's part of the BRICS, right? Okay. So they're part of the same thing, but there's also a way of, competing. The reason why I like India a lot, and I think India is going to play a very important role here, is because India has seen how China negotiated with US, and they've realized we're not doing that. But India has also seen the mistakes China made with the one-child rule and over-expansion, and what's going on with a lot of these properties that they build out in cities that looks like just like Paris. I don't know if you've seen the city they build in China. It's a city. Everything Paris has, it has. It looks identical to Paris. If you Google
the
this,
same kind of architecture.
if I show you the picture, you would think it's Paris. They spend billions of their own money to build a city replicating exactly Paris. That's what China did, okay?
Wow.
Everything they have a Champs-Élysées, same exact model. So China overexpanded very quickly. India's watching. China, they had their one-child policy. The average age of a Chinese right now is 38.4 years old. India is 27, 28. India's IIT Institute is producing incredible engineers. Many companies here will hire Indian engineers, and they're rock stars, better than MIT in many cases. So I think India is very important for the next 20, 30, 40 years. As long as India is there, China's going to hate it. They're not going to like it. The fact that Tim Cook right now has got a very hard job. I think Tim Cook in a span of 4 weeks lost $350 billion of valuation for Apple. One, because iPhone 15 didn't do what they expected it to do. Two, because China is now giving them a hard time, because China is their number one market of iPhones they sell. Now China's sitting there saying, wait a minute, we sell more iPhones in this country than anywhere else, yet you're giving our business to India? Who the hell do you think you are?
Right.
Then on the back end, the real war that's taking place is the semiconductor chips. And there's different levels to the semiconductor chips that's being built. And China's specialized in the cheapest kind to make, the easiest kind to make, where some countries have specialized on the tough kinds to make when it comes onto semiconductor chips. This is why China can't stand Taiwan being there. This is why China wants Taiwan, because Taiwan specializes in building the extremely technical semiconductor chips that the rest of the world uses. And then there's complete other aspects to this that you can get even deeper on. So Taiwan's going to play a very important role. We can't have a Russia, Ukraine, Israel, Palestine, Gaza, Armenia, Azerbaijan, Turkey. We can't have that taking place with Taiwan. Taiwan needs to stay separate. That needs to stay protected. How we do that, I don't know how we're going to do that. We're getting involved in one too many wars. But if Taiwan stays free and China relies on them, because China destroyed the world during COVID, absolutely destroyed. We realize 80% of medications being built there, 80% of the technology that we need is being built there. They controlled everything. Car pricing, used prices went up 50%. Like, what are you talking about? You mean to tell me I bought this car for $90,000? It's used. You're willing to pay me $130,000? Yes. Are you serious? Yes. Why? We don't have chips to make cars. Are you kidding me? No. Rolexes, they were making Rolexes for 18 months. They didn't have equipment to make Rolexes. You go to a Rolex shop, what do you have? We only have one watch. Can I order Rolex? No. 12 months, you're not going to get it. Are you serious? Yes, nothing. This is what was going on at our Rolex store. So the stuff that gets me optimistic is India, Taiwan. We're committed to the semiconductor business here. The things that concern me is China, Erdogan wanting to be involved in the Israeli war, because most people don't realize the most powerful military in the Middle East is not Israel. Israel is powerful, but Israel has 300,000 soldiers, of which I think 150 is reserve. Turkey has nearly 400 active soldiers, the number one military in the Middle East. If Turkey gets involved, be careful with these companies like Raytheon and Boeing and General Dynamics and these guys that are making a lot of money when there's wars. We have to be very careful with that when that's taking place. Ray Dalio says a depression could be possibly around the corner. A lot of these guys are fearing what is taking place today. Michael Burry shorted the S&P 500, $1.6 billion of his clients' money. And now he did it in a way where, you're kind of protected, but still, he's not optimistic about the S&P. What will happen? The rich are still going to get rich. The innovators are still going to find a way to win. The people who learn how to use AI on their side, they're going to advance and excel even more. The acceleration and the disparity between the rich and the poor is going to get wider and wider and wider. Why? Because most people are going to spend majority of their lives on Instagram, on TikTok. They're not going to learn a new skill set. They're not studying AI right now. They're not studying technology right now. Harvard did an article saying to stay competitive right now, every 18 months you have 10 new skill sets to learn as an executive. It wasn't like that. It used to be 10 new skill sets every 5 years. Now we have to learn 10 new skill sets every 18 months. How the hell do we keep up? We talk about only the paranoid survival. Like right now, you have to be looking at this shit's out there. What part of it do I control? What part of it do I have no control over? If not a billionaire or a hecta or a decamillionaire, man, I got to figure out a way to increase my market value or else I'm going to get crushed. You're going to over the next 10, 20 years. If you're going to spend more time on Netflix, more time watching all these shows, more time playing all these games, more time watching all these TikTok, Instagram, if you're going to spend more time on that than building value for yourself and learning new skill sets, fortunately for that community, they're going to be okay. This doesn't mean a recession is still not coming though.
Because only the paranoid survive, there's actually two things you need to be paranoid about right now. Paranoia number one is you can pull out of the market too soon and miss real opportunities. And since no one is going to be able to accurately forecast the timing, you have to be thoughtful about that. So one strategy might be just that you dollar cost average in every day, make sure that you have a certain amount of savings so that you're not going to find yourself in a panic situation. The whole purpose of having cash in a bull market is to make sure that you don't have a forced sale in a bear market. And I thought that was a really wise way. So we're going to optimize for options. To do that, you're going to want to be largely in cash and index funds. When I say cash, I'm talking money market, treasury bills, something like that.
5 points right now.
Yep. Which is kind of amazing. All day, every day, I'll take it. Now would not be the time, in my opinion, to invest in anything where you're not just an absolute complete expert, where you have so much disproportionate knowledge that you're able to really recognize a deal when you see it. But that's my rough guidance to myself.
I think it was fantastic, and we're very aligned. Look, you're sitting there watching some of these guys sitting on a lot of cash. Why are they sitting on a lot of cash? Are they sitting on a lot of cash in case it's the fan? Is that what they're doing? Or are they just kind of sitting on a lot of cash, wondering, I don't really know what's going on? When I say people, I mean Berkshire Hathaway. I mean, these guys have a lot of cash right now. They're sitting on the table. Maybe they're not buying value stocks yet because they don't yet believe value stocks are here. If you're not in this business, if you're not in the business of investments, financial advisor, broker, day trader, don't play around and get crazy about it. Crypto, a lot of people got into crypto and NFT, and that was not their world. They didn't know about it. They lost a lot of money. I mean, a couple guys made $90 million, but the people that bought their stuff lost $89 million, but they got their money. There's a lot of guys that made the money in NFTs, but it was a gamble for everybody. And everybody's like, oh my God, but I believe it and all this other stuff. Okay, great, that's pretty crazy. Does that mean NFTs are going away? Absolutely not. My kids still buy stuff on Roblox and skins and all that. There's an element of it that is not going to go away.
Guaranteed.
Is there 95% of NFTs that are not coming back? Yes, probably. Some of them are going to be gone. I have interest in things I know about. Jamie Dimon's got a $900 million art collection. Why? He showed me this yesterday that he paid $200,000 for it. That picture is probably worth $8 to $10 million today. Money in art being made, again, non-duplicatable assets are very, very valuable. Whatever there's few of, very valuable. But only touch it if you know a lot about it. If you know nothing about crypto, don't even get close to it. Don't get too crazy. Oh my God, I'm hearing, Bitcoin's going to go to 100,000. It may go to 500,000. But don't do it because you're guessing because somebody else said it. Do it because you've done a lot of due diligence in it. So if you don't want to have that kind of a risk tolerance, indexing is the way to go to play it safe. Now, to the small community of crazies that have an itch and a tolerance for madness. When you have a certain amount of money, I'm talking to my Goldman guy. He comes in, we're having our conversation. He says, hey, here's what I think we can do with this amount of money. I said, okay, what about it? He says, here's a strategy we can use the next 90 days. I said, do you have any questions for me? He says, I got one question for you. Are you okay if in the next 6 months we lose $55 million in this? What a great question. Just straight up. I'm like, no, I'm not okay with this.
Big nut.
He says, no problem, totally get it. Then we can't go the way that this is one of the options we can go on. Because what do you think are the chances of a World War III happening in the next 6 to 12 months? I don't know if I'm at 50%, but I'm at 10%. Well, 10 is pretty high. Okay, if that happens, how bad is it going to be? Like during COVID, Dow went to 18,000. I don't know if you remember for that minute that Dow went to 18,000. Everybody was like, holy shit, what's going on? but very quickly went back to 32,000. So it recovered very quickly. So what does this mean? If you think a possibility of craziness is going to happen, that you keep cash and it happens, you can buy in dollar cost average. Okay, yes. You think you're that brilliant that you can time it? Historically, very few people have been able to do it, and those who did got purely lucky. Do you want to be part of that camp? Because most people, historically, what happened to them? They missed being in the market on the 5 best days.
Right.
And missing those 5 best days ended up costing them the difference between making 13% over a 20-year period to making 7.8%.
Correct.
And that's a lot of money, by the way, between those two. So if that's not the world you want to play, don't do it. For me, the game we're playing is a different game. There's going to be a lot of assets for sale the next couple of years. And if you've made the right choices and you have cash, and some of these assets don't perform the next couple of years, there's the opportunity to pick up assets. There's different levels right now in the marketplace. If you have cash, a lot of it, companies are going to be for sale the next 3, 6, 12 months. And there's going to be a lot of opportunities for you to increase your market share within the industry. If not, you're somebody that doesn't have a very high risk tolerance, do not screw around the next 6, 12 months thinking you are Nostradamus and you can predict the future, because the market's going to destroy you. It's undefeated. We're 1 or 2 people away being offended of World War III getting started. You got 16 million to 18 million people died World War I, 60 million on 2. Third one, if we go at this trajectory, could be 200 million. The job that we have collectively is to try to do whatever we can to turn down the temperature, not increase it. If you and your wife get into an argument and you call me and you say, you won't believe what she said, my job isn't to say, she said that, Tom? Oh, dude, if she would have said that to me, it's done. Are you kidding me? Doesn't she realize how amazing you are? How lucky she is to have you? Instead, it's to say, come on, bro, she loves you. And you know you love her. She's partly right, bro. I'm gonna take her side. How could you say something like that? You're not on my side, you're on her side. Probably on this one end, but I'm telling you privately. I'd go back and try to make this work. Screw you, Pat. Totally get it, bro. Let me know if you want to talk later. You get off the phone. I have a job, and it's called Doug. Diffuse, unify, and be the glue. We don't have a lot of Dougs around the world today. We have division today. We have divisiveness today. But if there's that one strong personality, leader of the free world, a Churchill, a Reagan, a person you don't want to mess with, the world is typically a safe place.
What do you think the odds that we are already in some sort of Roman Empire-like decline? Meaning already in it, and that it will happen in the next 10 to 15 years?
Here's the best thing about capitalism. Capitalism prevents you from doing stupid things because it's going to hurt your capital. Jamie Dimon's not going to want to screw up what he's doing. And his legacy is going to matter to him, because there's no way in the world he's going to let Sandy Weil be able to say, I told you guys that guy failed, he was a nobody. He's not going to let that happen. And he's running the most, company that every day $7 trillion they see come in and out. JP Morgan Chase, right? Apple, Amazon, Gates, Microsoft, these guys have assets. Are they going to let something crazy happen to it? I don't know. Musk, who is standing up against the establishment, he's not okay with what the establishment's trying to do. And with social media, a lot of this bullshit's being exposed, whether it's talking about ESG and what BlackRock and they're trying to do, or Open Society Foundation, or these DEI scores, CEI scores, which California is famous for. They're getting exposed, right? And people are talking about it. So social media is allowing us to hold people accountable. I don't know if you saw what just happened right now this week with Supreme Court having a discussion to say social media companies cannot take anything off their websites.
Whoa.
This week. So censorship at the highest level. You don't have the right to take anything down. Okay, and they can protect sanity in America with some of the ways that businesses have been bullying people during COVID. COVID, what it did do, which was great, what's that quote? Absolute power reveals what this person's driven by, right? Lincoln said, if you want to test someone's character, give them power and see what they do. Guess what? During COVID, who did we give power to? If we're not oblivious and not naive, we realize what the people of power really wanted to do. So to me, it was fantastic to really see them show their cards. Oh, this is what you're trying to do to America. We're not going to let that happen. You got guys like Rogan to flip. You got guys like Elon Musk. Oh, so you were full of shit the entire time. I thought you were trying to do something good. Got it. I'm not part of your camp. I'm going to go buy Twitter. There's no way he's going to buy Twitter. Elon Musk bought 100% of Twitter. You just showed your true colors. Beautiful. That was fantastic. Hey, we want you guys to go and work from home. Really? Yes. I'm living in New York. I'm working for XYZ company. They're paying me $250,000 a year. I can't live normal life in New York. I'll go live in Florida. Work from home, except now I'm not paying the taxes. Oh, no. We don't want you to work from home. Why now? I can work from home from Florida. No, we want you to come back to New York now. Got it. So you screwed up the policies, but now I'm in Florida. I'm not coming back to New York because I actually love Florida. And I'm stuck here. And people from California went and worked from home in Texas, and now they're saving at 13%. Now they're not coming back. So they were like, oh, people are going to come back. They never came back. The people never came back. So this empire is falling. The great equalizer is social media. If social media sticks around, I don't think it's going to happen because I think on one end, capitalists, the rich people are not going to want to lose all their money. So they're eventually going to be like, yeah, I don't support what you're doing, Soros. Charlie Munger said something very interesting. He says, look, I love Larry Fink, but I don't want him as my emperor. What a thing to say. Because they know what Larry Fink's trying to do. People are not dummies. Those types of people, I think, are going to fight each other enough. And if we keep our eyes open, this will continue to be the greatest country in the world and hopefully even better if we rise up to it. If not, the best days are behind us. If we don't learn our lesson from the last 3 years, our lesson from the last 3 years, our lesson from the last 3 years, our lesson